Hello, everyone. So today we are going to start our new module, that is in the investment management. You have the first module regarding what is investment, what are different types of investment, differences between investment, speculation, gambling, different processes in investment. All these things we are having in the first module to learn. So in today's session, the first session, we are going to deal with the basic concepts in investment. So let us know what is investment here all about is. There were the meaning, definition, features, characteristics, objectives, and the important features of good investment policy. So the first one is the meaning of investment. An investment, as you all know, involves putting capital to use today in order to increase its value over time. So it's the concept of time value of money. So today what you invest is not the same value which is going to happen after a few years. So the value gradually starts reducing as and when the time moves forward. Then an investment requires putting capital to work in the form of time, money, effort, and this will give you greater payoff in future than what was actually put in the previously. An investment refers to any medium or mechanism which is used to generate future income, including like bonds, stocks, equity stocks, then real estate property, or any business opportunities too. Now let us see the important two definitions of investment. So the first definition was given by F. Amling. So F. Amling defines the concept of investment as the purchase by an individual or institutional investor of a financial or real asset that produces a return proportional to the risk assumed over some future investment period. And if you see the second definition, that is by Fisher and Jordan, investment is defined as commitment of funds which is made in expectation of some positive rate of return. And if the investment is properly undertaken, the return should commensurate, that means should equalize with the risk that the investor has really assumed. What are the important characteristics of investment? So the first is about the return. As you all know, return is equal to capital gain, there is capital appreciation, plus the yield, which is got through interest or dividend and so on. All the investments are characterized by the expectation of a return. In fact, the investments are made with the primary objective to derive a maximum return. The return may be received in the form of yield plus capital appreciation. The difference between the sales value and the purchaser's value is called capital appreciation. The dividend or interest received from the investment is the yield. And finally, we can say the return from an investment depends upon important factors like the nature of investment, the maturity period, and the various other factors. Second factor is the risk. If you see the risk, it refers to the loss or the probable loss that the investor has to assume during the course of investment, or it refers to the loss of principal amount of an investment, the probable losses. It is one of the major characteristics of the investment. The risk of in an investment depends upon various factors, like the investment maturity period is longer. In this case, the investor will have to take larger risk. Government or semi-government bodies are issuing securities which was having less risk. In the case of the debt instruments of fixed deposits, the risk of such an investment is less due to their secured and fixed interest payable on them. For example, you can say about the debentures. Then we have in case of the ownership instruments like equity or preference shares, the risk is more due to the unsecured nature and the variability of their return and risk nature. Then the risk of degree of variability of returns is more in case of the ownership capital compared to the debt capital. And finally, we can say the tax provisions would also influence the return of risk too. The third factor is all about the safety of principal amount. The safety of principal amount refers to the protection of the investor principal amount and expected rate of return. Safety is actually one of the important crucial element in the investment. Because whenever an investor goes for investment, he says whether it's safe or secured or not. Capital is a certainty of return without the loss of money, or it will take time to retain it too. If the investor prefers less risk securities, he chooses the government bonds. In this case, if you see, investor prefers high rate of return, investor will choose private securities, and safety of these securities will be comparatively lower. To safeguard against various errors that may creep in while making an investment decision, extensive diversification is suggested. The main objective of diversification is to reduce the risk in the loss of capital and income. A diversified portfolio is less risky than holding a single portfolio. So that's what we say in the diversification. You can have too many eggs in one basket. See, actually, you can't say that you can put too many eggs into one basket, because you have to go for diversification. So if you have one basket, you have to go for diversifying to the other. Why? Because the return of one can compensate the risk of the other. Next, the diversification, which you have just now spoken about, it is referring to an assorted approach to this concept. It was brought out by Harry Markowitz, and it's an assorted approach to investment commitments. It have two types: vertical diversification and horizontal diversification. Under vertical diversification, securities of various companies engaged in different stages of production, from the raw material to the finished goods, which are chosen for investment. Then we have the second type is the horizontal diversification, which means making investment in those securities of the companies that are engaged in the same stage of production. The fourth characteristic we can say is liquidity. It refers to an investment which is ready to convert into cash position. So the convertibility or the marketability or the transferability, that factor is discussed about the liquidity. And liquidity means actually the firm or the investor will have enough adequate cash balance to meet their uncertain future. For example, if they invest in UTI, that is Unit Trust of India, or mutual funds, all they expect is one thing, that whatever they invest, it should have higher liquidity. It should have the higher sort of transferability or convertibility into cash, liquid cash. Next is the legality. Investment securities must be evaluated from legal aspects before selecting them. Only such securities which are approved by law should be chosen as actually. For example, if they whatever is chosen by discussed by law, it should be taken into consideration. Whichever is not discussed by law, it is treated as illegal security. So it has to be considered. The best way to do with the investment is issued by LIC, UTI, post office, and so on. Then we have purchasing power stability. Every investor, before making investment, considers the future purchasing power of their funds. In order to maintain the stability of the purchasing power, he or she must ensure that the money value of the investment should increase in accordance to the increasing price levels in order to avoid the loss of money. Next is tax benefit. Tax implications of on the income provided by the investment programs should be taken into consideration by the investors. The real return earned by the people is one that is left after paying the income tax. While deciding an investment pool option, the burden of the taxes on its income is an important determinant factor which should be analyzed by the investors. He or she must choose such investment securities which will really put less tax burden, that is tax sheltered. So we can say like National Savings Certificate or Public Provident Fund, or we can say the EPF, Employee Provident Fund. Like that, or we can say NPS, National Pension Scheme, the contributory pension people, all the same. This will help in minimizing the risk and maximizing the return too. Next is about the concealability. So concealability is nothing but safeguarding or the financial instruments which is actually required, especially by investing in real estate and all. You should have some safeguard, isn't it? So concealing. So because with the investments which are highly prone to risk, actually that is brought under this particular, discussed in this particular factor, and accordingly the measures has to be taken. Whenever you invest in such securities, you have to take preventive measures, also curative measures to overcome the challenges. Now, let us see the important factors or the attributes of good investment policy. So any investment, whatever you make, it must be cost efficient, risk averse. You should know how to get away from the risk also. Tax efficient, then we have simple, it must be, then it should be transparent, easy to manage, then we should know that it's a tangibility, legality, just now we discussed concealability, then also capital appreciation should be there, liquidity must be there, stability of purchasing power, safety of principal amount, and finally regularity and stability of income. So these factors should correlate with each other to form a good investment policy. Last but not the least, let us discuss about the important objectives of an investment. So whenever you have an investment opportunity, the main objective behind why the investors go for it is because there are different important objectives, the factors considering them. So the need for investment or the objectives of investment, the purpose behind the investment opportunity are, first is that maximize the return, minimize the risk, safety of principal amount, capital appreciation, which can include conservative growth, aggressive growth, and speculation market. Then we have liquidity, tax exemption, protection for the future, and tangibility we have. Then we have hedge against inflation, whatever the interest rates are increasing. So what happens is when the interest rate is increasing, might be sometimes it is very low for, return for us. So when there is a money supply higher, so against such inflation, the hedging can be done with the help of such investments. Then we can say that is the fulfillment of social and self-esteem needs. So our love, belongingness, then we can the safety needs, and also our own self-esteem needs can be empowered. Then we have transferability, which is nothing but liquidity, then safety and security of funds, the regularity and stability of income, and save up for retirement opportunities, and we can keep for retirement. So there is a pension like that and all. Then we have long-term high priority investments like investing for the post-retirement period or education of the child and so on. And we have the low priority objectives like provision for tour or for domestic appliances and so on. So these are the important things that we have been discussing today. So thank you and have a nice day. Bye.